Hello, everybody. Welcome to CoinFund Q&A. We got a fun one this time. We have Ari David Paul joining us today. Ari is working on BlockTower, which we'll tell us about in a second. We got a fun one this time. One moment. We have Ari David Paul. A little echo here. Anyway, and what makes this CoinFund Q&A different from most of the ones that we've done in recent memory is, normally we're talking to early stage blockchain technology founders. I'd like to dedicate this one to talking a little bit more generally about the blockchain space, blockchain investing, maybe touching upon what is a crypto fund and how they operate. And these are organizations that are currently very active in the space and enable many of the technology companies operating in space to operate the way that they do. So welcome, Ari. Thank you for joining us. We also have Alex Felix with us, who is a partner at CoinFund. And let's take it away. Give us a little bit of an intro about how you got into blockchain and where you come from.
Sure. Thank you, Jake and Alex, and thank you to kind of the broader CoinFund group. So I was a derivatives trader, kind of a typical Wall Street trader for the first 4 or 5 years of my career. I traded everything from bonds, equities, even electricity forwards, pretty much every asset class, everything you could name. And it was very much with the mindset of you're trading kind of not a real thing. You're market making, you're trying to be the house, the casino. It was trading without necessarily even knowing all that much about the asset that you were trading. I then kind of moved to the other end of the financial spectrum as a portfolio manager for the University of Chicago Endowment. So a lot of schools, there's basically 20 schools in the US that have a huge amount of money. So U Chicago has a roughly an $8 billion endowment. And they're run typically as kind of a fund-to-funds model. So we're LPs in something like 350 external managers. And we decide how we want to allocate globally and then kind of due diligence on managers, as well as sometimes discuss individual trade ideas with the manager. So I was very, very happy in that world. The endowment world is great. It's really interesting as an investor because you get exposed to kind of this tremendous breadth of asset classes globally. What drew me into crypto was kind of a few different angles of trying to answer a couple of very basic investing questions. So after the financial crisis, I saw the federal balance sheet getting pumped up like crazy. If you do a Google search for, say, M1, kind of the base money supply or any of the broader measures of money, they're up staggeringly. They're up 3x, 4x, 5x from where they were in 2009. And we haven't seen severe inflation because you have all these disinflationary forces like robotics and automation. But a lot of investors have been saying, how do I get out of the dollar? Or how do I get out of these currencies globally that are being depreciated by their central banks? And gold, let's say gold doesn't look that attractive or you want more than gold. That was kind of one key question that led me to look for cryptocurrency, to let me look for an asset that central banks couldn't depreciate and that wasn't, and it didn't look overvalued the way, say, equities or real estate look to me today.
Mm-hmm. So basically you saw, you looked at the cryptocurrency space and you saw this kind of opportunity relative to a lot of the other major kind of like macro level investment opportunities or markets?
Yeah, it was probably trying to answer that question first of how do I defend against depreciation that kind of had me looking in that direction. A key challenge in the investment world in general is you have two elements, kind of the beta and the alpha. So the beta is basically, do I like investing in stocks as a whole at these prices? And people generally feel the answer is no. It's not that equities won't earn a positive return, but they're not super cheap. Things seem richly valued. And then there's the alpha side. So part of my job was to pick managers, hedge fund managers, real estate managers who could outperform their benchmark. And over the last 15 years, we've seen that alpha get eroded to the point that there's very few managers in the world who can eke out more than a couple percentage points a year over their benchmark. And there's a lot of reasons for that. One is it's just so competitive. So if you think of a poker table, professional equities investing today is like sitting down at a poker table with 8 professionals, and you're lucky if one guy who isn't a professional sits down for half an hour. There's a little bit of retail money, and it's professionals fighting against each other over this tiny little bit of mostly passive index kind of retail money. In looking also for where can a manager differentiate, not necessarily because the asset itself is going up. So for example, you have traders of crude oil who don't care if crude oil is going to be higher or lower in a year. What they care about is that there's volatility and inefficiency. So we're constantly looking for where is there inefficiency? Where can we maybe hire a manager who can add alpha in a space? And as I was looking at cryptocurrency, they were the most inefficient markets I'd ever seen. Tremendously inefficient, right? You had things like outright arbitrages available, which just doesn't exist anymore, kind of in normal finance.
Is that just a function of the size of the space, would you say?
So it's a bunch of things. The big one, I think, is actually operational risk. So, for example, those arbitrages require that you take on counterparty risk to exchanges. And you can put it in practical terms, is as a big hedge fund like Citadel willing to put $50 million on Poloniex and kind of have it sitting there? And I've talked to some of the big hedge funds. One thing they're very worried about is getting sued, is kind of what happens when a private key is lost. Maybe it's a trivial amount of money, right? From a risk perspective, it might be tiny. Maybe they put 1% of their fund in this and they lose 10% of that. But they're afraid of, it's not a risk they're used to taking. They're not used to having to worry about an exchange like the NYSE or the CME going down. Whereas in crypto, even the right. most trustworthy exchanges, I would argue there's a risk there. They're the world's biggest hacking targets. So one big part is, I think, custody from a legal perspective, as well as kind of a sleeping at night. So people always ask me, so far endowments and pensions have not invested at all in cryptocurrency, as far as I'm aware. If there's been an investment, it's been very much a one-off thing, and I've tried to hear about it. So the main thing that is going to change that, I think, is prime brokerage, some kind of custodial service that they can have confidence in, where instead of it being University of Chicago writing a check to a manager who's going to self-custody Monero, some kind of setup where it's Citibank or Goldman Sachs that is kind of custodying it. Part of that is a check the box. As institutional investors, we're fiduciaries. A risk that you might willingly take in your own portfolio might be hard to take on behalf of someone else. So I think that's a major obstacle to preventing institutional money and hedge funds and professional money from coming in and kind of eliminating a lot of these inefficiencies. The other thing was the size of the market was just so small, right? At the beginning of this year, it was a $15 billion market. That's just too small to be on the radar of a Renaissance Technologies or a Citadel, kind of the giant hedge funds. It's just too small to be interesting to them. Now that we're, I think we've come back down to something like 75 billion, but we were over 100 billion. They're starting to get interested. A lot of the boutique trading firms are getting involved. So for example, DRW, which is a giant Chicago trading firm, they have Cumberland Mining under them. And Cumberland Mining is one of the biggest OTC desks. And what you're seeing is these are people who have the trading expertise. They can transfer their skills from another asset class to cryptocurrency fairly easily. It's not to say they're gonna, I don't know that if they wanted to be VCs in the space, if they wanted to do what you guys are doing, they lack the expertise, and they know that. But if they want to be market making Bitcoin on a 10-second time frame, that's really not very different from market making crude oil or gold or anything else. Mm-hmm. So these boutique trading firms are getting in the game partly because they have less, they have more freedom. Generally, they're owned by a small group of partners. They're less public, so they're more comfortable taking on that risk. And we're seeing kind of the first wave of experienced trader, portfolio manager enter the space, of which I'm one of them. And I think we're going to see that continue to grow, and it will make the markets more efficient, and it will make it much more competitive to be trading.
So, as a high level, what would you say, your, core competency, or where you see the value of this opportunity in the long term? Is it the fundamental, view on, that you mentioned at the onset on cryptocurrency, having different properties from traditional assets and potentially being less inflationary than the US dollar? Or is it on just the extreme technical inefficiencies of the way these markets are, the infrastructure behind these markets today? And I'd even go as far to say that the geographical differences, where you mentioned operational risk, the markets in China are very different than the markets here in the US, and it's not, while crypto can potentially be sent around the world, fiat kind of can't. So there's also an imbalance geographically. But in the long run, do you see yourself being able to create a ton of value, technically, or do you see the real growth opportunity being kind of fundamental, and that the technical stuff is more of a zero-sum game?
So short answers, I think both. So I very much believe in buy and hold. I very much believe in security selection. This is a space where I think it's very valuable. So the firms that are the polychains, the metastables of the world that are fundamental, their edge is either economic analysis, fundamental use case analysis, and or analyzing the protocols themselves. You know, actually looking at the GitHub commits, reading line by line of code. Some funds do it more than others, but I believe in that. And when we're pitching family offices or VCs, we very much say, you know, that's an absolutely great strategy. In any asset class, there are a whole bunch of different ways to profit. And strengthening the asset class requires a whole bunch of different players. So I have tremendous respect for developers, engineers, the people working on the protocol. To me, they're the ones driving the value. The second kind of group I would argue driving the value are people like yourselves who are kind of picking the best among them to allocate capital effectively, to allocate capital to kind of build those new technologies. But having a robust capital market, having a relatively liquid capital market. So for example, a thing that kind of the boring market makers do is transmitting liquidity globally. So you have a lot of liquidity, let's say in China, you have very little in India. By arbitraging those exchanges as best they can, they bring liquidity to India, which helps local developers raise money, which helps, you know, have a, it basically helps get capital kind of a bit indirectly into the hands of the people who can put it to good use. Go ahead.
So I wanted to focus on one of the things you said, which is like there's a lot of ways of making money, and you know, for kind of more institutional kind of investors, maybe like larger crypto investors or crypto funds or VCs or family offices now coming into the space, right? In blockchain in particular, there's this like higher onus on investors to say to prove that they're like strategic, right?
Sure.
Because like what is the value that like a VC brings to a company, right? So in the context of blockchain, it can't be capital, because you have companies that are raising $100 million in 37 seconds and et cetera. So the value that a VC brings to like kind of like the pre-sale, you know, of an ICO opportunity has to be some kind of strategic value. And is that value, like, how do you see that? Is that value technological? Is that value unlocking some kind of access that they didn't have before? Because because the value proposition of capital is quickly eroding here.
Sure. Well, so one, these things always go in cycles. So the parabolic rise that we've seen in the last 6 months is very much the exception, not the rule. The ICO craze is, again, kind of the exception, not the rule. I'm not saying that it won't continue for another year or two. I'm not saying it won't have 3 more lives, but it's not, it's very similar to, you could have asked the same thing about tech stocks in the late 90s, where why do we need VCs at all? Why do we need kind of any investors? If you add .com to your name, you raise $100 million. And that was true for like 2 to 3 years, right? And then it wasn't. And then it was, again, very hard to raise money if you were a tech startup. And that was where talented VCs who would allocate to the better startups kind of played a role. In 2000, 2004 was very hard to fundraise if you were an entrepreneur. So one thing is, I think there's a temporary element. So I've had companies reach out to me asking about governance. So for example, people are trying to, it's not an easy, there's no easy answer to what is the perfect ICO. Assuming you're a developer, you're a company, and you want to do a totally ethical, optimal ICO, it's not obvious what that looks like. So I think VCs can help with that, help with structuring the offering, aligning incentives. At the moment, it's still a very almost incestuous space. Kind of everyone knows everyone to some degree, at least maybe with geographic fragmentation. So it's kind of interesting to me how few people in the crypto world I know in Japan, South Korea, or China, something I'm very actively trying to remedy. But at the moment, I don't know that introductions are super valuable, but they will be. A big part of what VC does is just, you know, hey, you're a company, you need a CEO. You know, you've got a brilliant young founder and the company's now grown, and we're gonna find you a professional CEO or COO, a Sheryl Sandberg to your Zuckerberg kind of thing. So it could be introductions there, introduction to service providers, applying discipline. Huge value there. But so to kind of finish.
Sorry,
yeah.
To just dive into that like a little bit. Does that presuppose kind of a traditional corporate structure, right? Because we do see projects, and this is one of the really interesting things about the space, that are building decentralized networks and decentralized governance for those things. I mean, and it's not like one or two, it's a lot of them, right? It's like you're talking about Augur, you're talking about Aragon, you're talking about how District 0x will do governance, you're talking about how Definity and various blockchain and smart contract platforms and networks will do governance. So, you know, when a VC will go and introduce a CEO, surely, but that is sort of like the traditional context. What about the new context where these things are like wholly community owned? What value does a VC bring there?
So I think it's very much the same role, but the person looks a little different. So in the past, 5 years ago, it would have been one of the giant VC funds, a Sequoia, an Index, a first round. Today, what you're seeing is a lot more angel investors. You're seeing, there's always the role of the connector, right? So you have teams of developers all over the place. We're all inundated with information. Yes, the information's at our fingertips. Yes, theoretically, I can look through 1 million resumes. I could look through every CEO on the planet. Everything's transparent. Realistically, that's not how things work. Having that connector, so you think about people, like something that really struck me as an institutional investor was when I met Naval Ravikant, you know, kind of the philosopher king of our industry, which is I think a well-deserved kind of well-deserved moniker for him. What struck me was I did a Google search, and an entrepreneur described him as the friendliest money in the valley. And it struck me, and I had seen a headline that said Sequoia was sourcing deals through AngelList, which was such an absurd headline. Sequoia being one of the very, very, very top VC funds in the world that everyone runs to. AngelList 5 years ago being kind of for amateurs, at least that was the perception of my industry. Mm-hmm. And the idea that Sequoia has to turn to AngelList for deal flow. And the reality is that the role of the VC as the connector, as the advisor, both in terms of structure and form of offerings, of how to kind of connect with service providers, of legal wrangling, and also just connecting in the industry, it's now being played by people like Naval. Increasingly. So the role doesn't go away. I agree, the legal structure maybe changes. So maybe instead of it being a VC fund, maybe it's someone leading a syndicate on AngelList. But I think it's the same value add.
Awesome. So let's go a little bit more into, so we talked a little bit about the market, and we didn't dig too much into like what these assets are, but let's table that for a second. But let's talk about what is a crypto fund, like in the context of these VCs, of these hedge funds. You know, you coming from a more like endowment and more kind of traditional background. Mm-hmm. What is a crypto fund?
So I think I mentally divide it into 3 buckets, which is a little bit artificial, but you basically have the long only buy and hold. And some of those guys may throw in a short or two, but basically what they're betting is they're betting on beta. They're saying, we believe in the story, we believe the market cap's gonna be much, much higher in 5 years. We're willing to take the ride. So if the entire market crashes 80%, we're gonna be down, maybe not 80%, but we're gonna be down a lot. But you're with us for the long haul, and we're gonna add value by picking, let's say of the 40 big protocols, we're gonna pick the 5 best ones or the 10 best ones. So those are kind of the buy and hold guys, and I very much believe in that. I think people will do very well with that. I think investing in that makes sense. At the other end of the spectrum, you have kind of the machine learning, neural net, AI, algorithmic, all the terms kind of used somewhat interchangeably, which I know is incorrect from kind of a data science perspective, but just tends to be very short term in duration. So the trades will usually be less than an hour, sometimes less than 10 seconds. And it tends to be increasingly non-discretionary. So you're creating code and the code just runs and that's it. Right now, that's very low-hanging fruit. Right now, everyone that I know personally who's running any kind of algo is crushing it from their basement. So a lot of these people are people who have a day job at Fortress, at Citadel, at a boutique trading firm, and they're just applying the algorithms they use into the treasury market to cryptocurrencies. It's low-hanging fruit right now. It's about to get much, much more competitive because once a day, I have someone reach out to me saying they're launching an algo hedge fund. A lot of them are pretty small. In crypto. Oh. So the number is astronomical because it requires very little overhead. These are people who, a lot of them made some money in the last 6 months, and they were, for example, you had a professional trader who works at Fortress who makes 400 grand a year. They turned 100 grand into 2 million in the last 6 months, either with buy and hold or with their own kind of algo. And so now they're like, hey, why don't I launch my own fund? I got a couple million of my own money. I've got friends and family who will throw in a few more million. You also have some big players getting in. So you have firms like DRW that are scaling up, allocating more capital, allocating more headcount. It won't be that long before we see Citadel and players like that tiptoeing in to the algorithmic trading side. Some of the main things keeping them out at the moment are it's very hard to go short. So currently, if you want to go short, you basically have to collateralize it. There isn't a good futures market. So like this is kind of it's a really simple idea, and yet it's profound. So running a fund, I'm terrified of exchange counterparty risk. I'm terrified of losing. It's like my investors are taking investment risk, right? There's a risk the market goes down. There's a risk I make bad investment decisions. That's a risk that we take as investors. The operational risk, though, is something we have more control over. So the idea of losing $1 of my investor money because an exchange that I have that on goes down or freezes our accounts indefinitely, I need to do everything I can to mitigate that. And so I can move cryptocurrency off an exchange, but I can't move a short off an exchange. I can't cold storage a short position. So I have to collateralize a short position usually with most exchanges. And the hedge funds don't want to do that, and that makes running kind of a lot of the market-making strategies very, very difficult. But as the markets mature, they'll be getting in and in size. So those are the two extremes. You have kind of the machine learning, the buy and hold. We're in the middle. So we're applying what to me is kind of, it's probably best to use examples. So it's almost anything that isn't one of those two. So event-driven bets. So for example, analyzing things like the upcoming Bitcoin hard fork, which which I'm happy to dive into, but I'll say right now, I don't feel like I have great insight on at the moment. So our fund hasn't launched yet, but at the moment, I wouldn't be placing a bet on it because I don't know that I have edge over the market. But situations like that often provide opportunity where we're able to do better research, get access to information, think through the situation. We're going to be activists to some degree. So I feel like at the moment, the ICO market is fairly crowded. There are a lot of people looking to add value to ICOs. And I don't mean to say they won't do a great job doing it. I just don't know that that's kind of an area where I want to compete. But you have a number of cryptocurrencies that are low market cap that have dedicated developers that we could, for example, buy up a meaningful percentage of the outstanding coins, hire more developers, use a mixture of connections, and sometimes it's pay to play to get those coins listed on more exchanges globally. We could provide liquidity, and then we could publish research. So if we see something that we think has fundamental potential, but is maybe struggling partly for monetary reasons, we can kind of help drive outcomes.
That's really interesting. And so does that apply to like a pure cryptocurrency, or does that apply to a specific kind of cryptocurrency with novel features like anonymity, or are you kind of saying like, oh, I want to flip houses in the pure cryptocurrency domain almost?
Right.
Or are you saying like, I will identify specific like novel ones that I'll do that to?
So I think the best way for me to distinguish is fundamentals versus fundamental narrative. So you have people who are looking at the protocol themselves line by line and saying, I think the consensus mechanism of Tezos is sound or unsound, or I think proof of elapsed time, or one of these kind of interesting new consensus mechanisms. People are looking at that and they're making a bet on fundamentally, is this a consensus system that will be sound in 5 years or 10 years? That's not a bet that I'm qualified to make. So I talk to engineers all the time. I talk to everyone I can find who are the best and brightest, and I basically take what they tell me on that. So if they tell me that a particular cryptocurrency's decentralized file storage system is transformative and another one's is kind of crappy, I'm trusting the engineers on that. Where I hope to add edge is more the space between the engineers and the market perception. So for example, part of the reason Bitcoin had its big bear market in 2014 and 2015 was there was a perception among participants that Bitcoin was Visa or soon would be. And we know that it wasn't, right? It was 7 transactions per second. It was no secret. Any blockchain engineer you ask, everyone agreed there was this fundamental scaling challenge, right? And it wasn't a question of, you could have a debate over how will we resolve it, but everyone knew there was this fundamental challenge who knew anything. But a lot of people didn't know anything. A lot of people buying Bitcoin really thought, hey, we're going to be using this to buy coffee in a month. Similarly with Ethereum, I think the leaders of the project, people like Vitalik and Vlad, have been very open the entire time about their roadmap and about what Ethereum can handle. However, a lot of the people I see investing in Ethereum thought they were buying something very different than what they were getting. So I was very, very bullish on Ethereum when it was $10. I viewed it as a VC style investment. This is very early stage software. We don't know what it's going to look like as code in 2 years, and that's fine. And it's incredibly promising with a great team. It's innovative. The problem was that as time went on, people started buying Ethereum thinking they were getting a mature smart contract platform. They were getting a mature platform ready to deploy decentralized applications. And the reality is, Vitalik and Vlad have said over and over, is it's not. It's not. It can't. It hasn't scaled yet. It can't handle that volume. It hasn't been tested anywhere near enough. It's basically beta code that is incredibly promising, maybe world changing. And so, as a trader, I look for discrepancies between the fundamentals and the fundamental narrative. And so, with Ethereum, for example, a few, maybe 6 weeks ago, we started seeing congestion on the network. And so I thought, I had a fairly large, long Ethereum position at the time, and I thought, this is about to become a story. So at the moment, everyone's buying Ethereum thinking, this is the bet on smart contracts. And that narrative was about to change to, this is one of 6 bets, right? There's also Tezos and Rootstock and Definity and EOS. And maybe Ethereum, maybe we should believe it will win, but that's a different narrative, right? Now we're questioning, will it be the ultimate winner, even if we believe in smart contracts? And then the network congestion forced everyone to come to terms with, this platform is not ready to do anything that it really promises to do in the next 6 months. And no way am I saying it won't meet that promise later on, but so the market kind of is readjusting to that reality.
So I actually think that's probably not one of the narratives that people are actually trading on right now. Because if you look at the comp, right, that's actually Bitcoin, right? Bitcoin has been dealing with scaling issues for months and over the entire past year and back in history, and the price is still going up, right? Because people think one day it will be solved. So like actually saying that, that's a trading narrative around, it's been well publicized for a long time that scaling issues are a huge roadblock, and yes, it was. I would say that we actually saw them happen for the first time, right? We saw like tangible proof that, okay, right, these guys are, a lot further away from, being able to settle that. And I guess the scarier thing is contagion, right? When one product clogs the network, none of the other products work. But I see sort of, one of the fundamental moves of why things have traded off a bit as, just massive amounts, to your point about liquidity, massive amounts of, ICO money being raised as another potential catalyst, and that, money being raised for platforms that aren't even built on the Ethereum network. So they really don't right, have any connection in the long term to Ethereum. Ethereum is just the financial rail at which, people invest in those things. So that's just a quick comment on that narrative, and maybe, there are probably a whole number of other reasons, right? It ran up a huge amount and, settling back down a bit, one narrative. And
absolutely.
But, yeah,
these things are so volatile that for a 50% move, you don't even need a reason.
Yeah.
Right. So I agree, and there's a human temptation to explain everything, right? So that like Bloomberg will automatically generate headlines anytime a product makes a new high or a new low, and there's always a reason. We as humans, we need reasons. So absolutely, there could be no reason, and it could be that my reason's totally wrong. I will say, at least for some people, like it's amazing kind of how so fast we've had kind of this day trader industry pop up. So I'm in a bunch of Facebook groups that people have invited me to that are kind of cryptocurrency trading groups that have a few hundred members. One is 1,500 members, and it's generally very smart people. A lot of Ivy League grads and people who work in tech and have no idea how to trade. And it's kind of it very much feels like it's like 1998 in the sense of the day trader, the mom and pop who don't know what they're trading. So it's like, hey, do you guys like this stock symbol? It's like, oh yeah, I love it. It went up 2 weeks ago and a week ago and 3 days ago. It only goes up. And so part of I see those. I don't know. It's very hard to know what percentage of the market those people are, right? We don't have great transparency into this market. We can see exchange volume, but there's a lot of trading that happens off exchange. The OTC markets are getting bigger. When a sovereign wealth fund buys 50 million in Bitcoin, they do it OTC with Cumberland Mining or Genesis Trading, and I don't see it. So it's hard to know what percentage those people are, but at least some of them. I saw the narrative.
Last year it was something about like half of the Bitcoin volumes were on OTC. As statistics from, I don't remember who it was from. It might have been like ItBit or something. But yeah. I think at this point it should be like way more volume probably on OTC than on actually the public ones.
I think a lot of that is the lack of exchange infrastructure. So everyone's dying. So one area where I hope that my firm will kind of be a good actor in the space is we're going to be pressuring exchanges to be more transparent, more accountable, and more professional, because we need that. And hopefully by doing that, by us and people like us doing that, will help prevent a future Mt. Gox. We'll be driving volume to the better run exchanges. The exchanges with more, basically we're demanding, it's similar to the idea kind of in equities in general, where when you have professional investors investing in a company, they tend to be more demanding. They actually look at the compensation of the board. They look at how the company's being run more so than kind of mom and pop. Very much true with the capital markets. So the average retail trader is looking at, Bitfinex and Poloniex and Kraken and Bittrex and basically looking at where the volume is, or looking at how quickly they can create an account. The people like myself who have to kind of really worry about counterparty risk, we're diving deeper. We're looking at their financials. We're seeing how good is their infrastructure, and we'll be sending volume, and the better run exchanges will be more likely to prosper because of it. So I hope that that's kind of one way, because I love the cryptocurrency space. I love being involved in the creation of, in this world-changing technology, and the creation of this value. I'm not an engineer. I'm not even really an entrepreneur, kind of within the financial world, I guess. But I have this skill set that I can bring to the table that gets me into the game. But I very much want to be supportive of the ecosystem as a whole, kind of every way we can. But the direct day-to-day things that we're doing are, I don't know if I'd say zero-sum game, but I certainly wouldn't say as value additive as a VC or kind of what you guys are doing.
Awesome. So taking back, sorry, Alex, just one question to the exchange kind of discussion. Do you think exchanges are going to be more centralized and more regulatorily compliant as we go forward, or do you think they're going to be more decentralized and global, and things like Ether Delta and Oasis DEX? And maybe something built on Cosmos will rule?
Short term, I think more centralized. And the reason for that is it kind of goes to where we are in the maturation of the smart contract platforms. So you take something like Ether Delta, which Ether Delta is actually the only decentralized exchange that I personally traded on because there was a particular token that I wanted to buy that required it. With in no way knocking the creators of Ether Delta who had a challenging and did a tremendous job. It's a horrible experience because you're relying on, we often kind of say, does this have to be decentralized? And there's very obvious reasons why you want to decentralize exchanges, but there's very obvious costs. Exchanges handle a tremendous amount of throughput, and they need to do it at very low latency, right? If I'm on an exchange, even if I'm a manual trader looking at a screen, I expect my screen to update every second.
Yeah,
right? I don't expect.
Sorry, but what about like the 0x protocol and underlying relayers that will basically solve the problem that you're alluding to, which is latency, throughput,
centralized order books. Centralized order books.
Automated order matching is an issue in a purely decentralized smart contract context, but it gets solved by a 0x type protocol.
So I don't think there's that much of a difference between what 0x or Omega are planning on doing versus if you just had a hedge fund like Renaissance that was going to mirror liquidity on every exchange. So the kind of, if one fund wanted to do this, what they would do is they would have their own centralized server, they would pull in all the data, and then they would be a market maker on every exchange, arbitraging every other exchange. Funds do that in equity markets and commodity markets and bond markets. I did that in bond markets. It's routine, it's not hard to do. The idea of doing it as a protocol, as kind of a separate offering, may make sense. Frankly, I've read the white papers, but it's not something that I don't have a strong opinion on the exact way to optimize and kind of the right way to do it. It isn't. I think it's if a fund does it, they're going to make a lot of money doing it, and it provides a valuable service because it increases there. But it isn't transformative. It might be transformative to the casual trader. If you're an amateur trader who's currently click trading on Poloniex, that might be wonderful for you because you don't need 5 exchange accounts. You don't need to have them all open. But every professional trader already has access to all the exchanges and all the order books. It's not that hard to get. They're even off-the-shelf services like CryptTrader or Coinigi that will facilitate that for you. So really what a lot of those protocols are doing, I think, is it's risk transfer, or it's a service. It's a piece of software that aggregates trade books and lets you send an order to multiple exchanges. Like, in other words, there's value, but it doesn't fundamentally change the challenges of the market, which is the counterparty risk still exists, right? Someone bears that counterparty risk. If the exchange goes under, it goes under.
So let me ask you a question though here, and so we're talking a lot about liquidity getting better in the markets and that helping to grow the asset class. But you mentioned some of the problems here are, you can't take a market neutral strategy, being one, right? You can't short well, and so we really don't understand, the valuation of these until we have more efficient markets, to help, long and short positions, find a healthy balance there. And the second point you mentioned is, that liquidity, or that you mentioned that there's a lot of, algo traders in this space. And in my opinion, it kind of sounds like, and this has no evidence or facts behind it, but that there's a disproportionately large amount of algo traders and technical traders because it's a technology-driven asset class, right? So it's like I said, there's low barriers of entry to executing on these strategies with APIs and simple markets, and you don't need a certain amount of capital under management to go to a prime broker and kind of get set up to trade electronically through their exchanges. But you highlight like a number of infrastructure risks and some other things, and so my actually thought there is, isn't this a bit dangerous? Isn't it a bit dangerous to try and generate and create a whole ton of liquidity in a market where we're still working on what the technology stack might be and what promising project opportunities there are out there? And do you think that making the asset class bigger is necessarily better? Do you think that the fact that there's a ton of money in this space helps support ups and downs? Or do you think, a catastrophic risk will actually, set us back way further because so many people lost so much money? So it's kind of a question of like, how do you run a market neutral or how do you have a quantitative strategy without really understanding, what these things are, what these underlying assets are? First and foremost, before there's actual implementations of these projects, and I mean that is like, there's really, outside of kind of pure cryptocurrency, and I'd love to get your thoughts in a couple minutes on just how you distinguish between different assets in the space. But outside of that use case, there's not a lot of applications with end user interaction and even in production, right? So a lot of these things being traded are kind of IOUs on projects that are being developed. So kind of free form, just those are some of my thoughts. Curious about comments.
Yeah, I think something that's really challenging about the space is cryptocurrency. I've struggled, and I think people who've tried to think about this have struggled somewhat with, is it an asset class, is it an industry? And neither term is quite correct. I compartmentalize by a few different use cases in kind of the way I mentally break it down, as well as for fundamental valuation. So you have store of value is kind of one, is really the only proven use case for crypto. And in no way am I saying there won't be other use cases. I very much believe there will. But the only one that's currently being used kind of at scale is store of value. Bitcoin's the leader of that. I think Ethereum Classic is actually competing in that regard. It's not clear to me who else is really competing. Store of value from kind of a competitive strategy perspective, like if I put on my MBA hat, a key question in any industry is, to whom does the value accrue? So like you look at the airline industry, from 1950 to 2000, you had massive revenue growth, you had tremendous value created for consumers. The airlines didn't make any money, right? Because they competed profits away. So you have store of value, which is best modeled as a commodity, and there's no way to come up with a fundamental value for that. The more valuable Bitcoin is, for example, the more valuable it is, because the more liquid it is, the deeper the capital market, the better it's able to fulfill its function as a store of value. That kind of can lead to excess volatility, right? If we all think that way, if we all think the more valuable Bitcoin is, the more valuable it is, and the less valuable it is, the less valuable it is, you get kind of these vicious cycles. Whereas with an equity, well, most of us would say, if Berkshire Hathaway is trading under liquidation value, we're going to step in and buy. We become fundamental buyers. Whereas if Bitcoin, I'm more of a buyer of Bitcoin at 2,500 than I am at 1,000. So that's the store of value one that's very hard to fundamentally.
Highly reflexive, right? And there's no terminal value.
Absolutely. What makes me comfortable with the store of value case is I think there's just such a giant fundamental demand. So cryptocurrency is the first unseizable store of asset in human history. It's the first asset that a corrupt judge, an oppressive regime, that can't be taken from you. And I think the fundamental demand for that is well over 10 trillion. And the evidence for that is you add up all the money in Cayman Island bank accounts and Swiss bank accounts and hidden ounces of gold. You add up the large portions of the world where whenever I say this in America, people always give me kind of dirty looks like, we're in America, like why, what do you have to hide? But if you're an Indian, you just had a lot of your wealth lost due to demonetization. If you're in South Korea, you only own your wealth within South Korea. You're not allowed to take it outside the borders. So do you really own it? If you're in much of the world today, even today, we're in a relatively kind of good period in human history, probably a third of the world's people have to worry about having their wealth confiscated through demonetization, through, Australia even did a retroactive deposit tax on checking accounts. It was tiny, it was trivial in size, but just this idea that your money can be retroactively taxed. So the fundamental demand for a store of value that can't be seized, I think, is massive. Then there are these tremendous other more interesting use cases, more interesting, at least more kind of richer technologically. So you have, the pricing of a scarce resource. So it's interesting thinking about, you guys, I'm sure, have educated a tremendous number of people about why does this have value? Why is it interesting, right? And I find the answer to those questions, what will click with people, really depends on the listener. For the Wall Street types, who I'm usually kind of preaching to, or the institutional investors, the use case of creating a market. So just, we have excess file storage. The analogy I'll use is something like Airbnb, right? So you have excess, you have a spare bedroom. By allowing you to price that, by allowing you to put it on the market, you end up with a more efficient allocation of resources. Everyone ends up being better off because now you have a marketplace for this, what was kind of excess capacity. So that's a tremendous use case. And there, I think you can apply some fundamental valuation techniques. Like Filecoin will to some degree be competing with Amazon Cloud Services. And so we can at least try within an order of magnitude or two to say, certainly we can probably come up with a ceiling. So that there's a maximum amount that kind of the excess file capacity of the world should be worth today, right? Just because we can kind of see what people are willing to pay for that. So we can come up with an order of magnitude. One area that I think is really challenging and interesting is cryptocurrency as brand loyalty, as the equivalent of airline miles. So I had an exchange. I had a beer with the creator, or the guy who runs the Pink Coin community. And I tweeted about it. And I just said I had a beer with the guy. I didn't tell anyone to buy the coin. I just said I had a beer with the guy and I like the community. And someone said, if I want to give to charity, why would I do it through Pink Coin? Why wouldn't I just give to the Red Cross? My answer is, why do people do Race for the Cure? Why do people wear a Livestrong bracelet? Why do people do CrossFit instead of just working out by themselves in their gym? As humans, we like, why is brand valuable? Why is Coca-Cola valuable, right? The reality in business is most of the most valuable companies are not valuable because of their intellectual property. They're valuable because of their brand. And I think we're going to see a lot of that in the crypto space, where you have a cryptocurrency that the engineers say, this isn't innovative. It's just a fork of whatever. It's a fork of Ethereum or Bitcoin, or it's not technologically interesting. But with marketing, with brand, it will create value.
Awesome. Just a quick note on what you mentioned about the sort of the Cayman Island and unseizable assets. And it sounds like it sounds like you're referring to basically like the shadow economy, right? There's a really great report which breaks down the shadow economies by country, and like very, very clearly demonstrates that the size of this economy is the second largest economy in the world after the United States. So yeah, it's a really huge market. It's one of the use cases for anonymous currency, right? Something like Zcash or Monero, and I think one of the reasons why people are kind of like very long-term bullish on those things.
A really interesting fundamental question that I'm struggling to wrap my head around, and I'd love you guys, to kind of your thoughts on this. So with Bitcoin, we had Bitcoin and the blockchain were born together, and they were inseparable. You had one cryptocurrency, one blockchain. Then we had a bunch of cryptocurrencies on one blockchain, right? So now we have, 100 tokens that are on top of the Ethereum blockchain. Why reinvent the wheel? And now we're soon going to be going the other way. With an atomic swap, you can theoretically basically have a Bitcoin on the Litecoin blockchain. To what degree, so for me, that makes it real. I kind of in my head came up with a decent model for how I thought about the whole crypto world and what I thought things would look like in 10 years. And then I realized that kind of all falls apart if individual cryptocurrencies can trade across blockchains. Because then what the differentiating factor of a particular cryptocurrency kind of fades away. So like, right, so if a user has the ability in a year, let's say, to easily pick and choose the best features, if I can have Bitcoin's hash power with Ethereum smart contract functionality, with Monero's ring CT, anonymity, and I can combine all of those using atomic swaps. How do we think about valuing each piece of that? Does Monero accrue the value? Does Ethereum? Does Bitcoin? It's something I'm struggling with.
Yeah, I could give you my take on that, and maybe Alex has a different take. But I think what you'll find is that yes, everything is heading toward interoperability, obviously, right? Because you need to be able to, just fundamentally, you need to have cross-chain portfolios of cross-chain assets, and so things like Cosmos, Polkadot, blockchains of blockchains, blockchains of platforms. Those are incredibly important infrastructure tools that connect these assets across chains. But where does that leave differentiation? And segmentation of these things. And my take on that is that if you dig into the tech, you'll realize different platforms have different strengths. You have some platform that's bigger, and so it is cryptoeconomically more secure, right? You have another platform that doesn't have a Turing complete language, but has like a sub-Turing complete language, but that enables much more secure smart contracts like Zen Protocol, who we interviewed here a few weeks ago, who are building a language based on F-Star, Microsoft's open source kind of functional language. You'll have certain platforms that are good at doing financial instruments, and you have other platforms that are good at doing DAOs or something, or some configuration of that. And then they're all connected. So I think some differentiation factors will definitely be preserved, even in a world where all these tokens are interoperable. And then kind of going back to your point about brand, right? Like one of my favoriteest of all time talks on blockchain is Andreas Antonopoulos' talk called The Future of Bitcoin, where he basically outlines the idea that cryptocurrencies and like the transfer of value it's just a form of communication. It's a form of denominating different things that is a very human thing, a very intrinsically human thing. And so I think on those two kind of points, I think you'll still see many different assets sort of in one world together.
So I'd love to use that as a jumping point for how do you segment these assets into either by nomenclature or various use cases? And you mentioned like Bitcoin's sort of it's worth whatever people are willing to pay for it, and therefore for some of these digital assets there's theoretically no terminal value. But sort of where do you see the fundamental opportunity in this space? If you're going to sort of be that hybrid, you mentioned almost a restructuring or activist use case. You mentioned a sort of arbitraging and technical use case, and then sort of is there a fundamental approach that you're going to take as well, or that you think is an extremely compelling opportunity today?
So a lot depends on kind of value from whose perspective. So value from the world's perspective, I'm most excited about projects like Blockstack and Filecoin, IPFS, kind of big world-changing innovative protocols that are technologically ambitious. Things like that aren't necessarily the best investments. So you look at something like, Filecoin's a great example where if Filecoin takes over the world, we all probably benefit tremendously. It's probably, we have cheaper access to file storage, we have more efficient allocation of resources. Probably we all benefit as a world. The question is, do the Filecoin investors monetize that? Do they capture much of the value? And I don't know. I'm not saying they don't. I'm saying it's not super clear to me that they do. So So as a citizen of the world, I'm most excited about a lot of the kind of basic technological innovation that's going to remake the internet. That's going to do. I'm really excited about some of the kind of humanitarian applications. So you can use the blockchain for fraud-proof voting, for example. It's something I'm very excited about. Something that we hope. I mean, I don't want to get ahead of ourselves, but I hope that in 6 months we're starting to have a kind of philanthropic wing where we can where we can support projects that are applying blockchain and cryptocurrency tech to really wonderful. I mean, I'm a huge fan, for example, of the work that BitPesa does. You know, P2P transfer. It's amazing when people say, who uses Bitcoin? Is it just the super rich and drug dealers? And you answer, well, actually, there's a pretty big use case in Africa on people making less than $3 a day, and they're sending $1 to their uncle in a neighboring village, which is really incredible. So, you know, you have a lot of those kind of really transformative, globally beneficial use cases that I'm really excited about, and as a member of the ecosystem that I expect to support. As an investor, as a fund manager, it's quite different. So I'm mostly looking for inefficiencies, and that means really anything that you can monetize. Anytime the price of an asset is very different from where you have reason to believe it's going to be over some time period. So if you can, the Warren Buffett mentality is, I'm not going to worry about time. I'm not going to worry about what's driving the market psychology. I'm just going to buy things that are fundamentally undervalued and then wait. I think that's tough in this space. So I don't think there's anything wrong with that if you're betting on the best technologies and you're basically price insensitive. So what most of these buy and hold guys are doing is they're not saying the fair price of Ethereum is X. What they're saying is, I look at the landscape. My investors have given me $50 million to invest. I'm going to buy $50 million worth of cryptocurrency. I'm going to buy the best ones. And I might be getting in at too high a price or too low a price. But if we think that over 5 years, everything's going up, or not everything, if we think over 5 years, the market cap's going up, then as long as I pick the right protocols, I'm going to do fine. I think that's fine. Our time frame, my skill set, my training, my background is just a shorter term kind of duration. I'm not an engineer. I can't read kind of the line, or I can read the code, but I'm not going to be adding value in that way. And so we're looking at things like, here's a way that we can be helpful, for example. So you have a lot of people who are reacting to the August 1st drama of Bitcoin in a very, very panicky way. So there's a rumor on Reddit, and you know, people rush to sell, and then there's a tweet from one person, one Chinese miner, and everyone rushes to buy. And you'd hope that having kind of smarter, more professional money would take the other side of those swings and help stabilize things. That's not always how things work, right? Plenty of the machine learning can be momentum traders that can actually exaggerate the kind of volatility. But at least what I'm doing kind of the short and medium term is I'm almost always contrarian. So when something is kind of in a raging bull market like Ethereum, where there's a true fundamental story, it's great. I'll ride that with everyone else. I mean, I believe in it. I'm happy to invest in it kind of at the right price. But most of the money is made being a contrarian. It's when other people are too greedy or other people are panicking. And I think we do help the markets a bit. We help the ecosystem a bit by, I mean, here's an example. So let's say Ethereum crashed to $20 and didn't immediately recover. It wasn't a flash crash, right? At that point, you would start having a fundamental deleterious effect on the ecosystem itself, I think. So Ethereum falling from 400 to 150 is probably very healthy for the Ethereum ecosystem. I don't think it hurts. You know, there's still plenty of money there. There's still tremendous development. There's still, you know, this massive, you know, wonderful kind of engineering base that is building up. At some point, though, the price could fall far enough that people become disincentivized. They start looking at other protocols, other projects. So having stability in the capital market, having that fundamental bid, like one of the roles that Wall Street traditionally played was they were the buyer of last resort. So when bonds were selling off, if there was a panic in a particular junk bond or corporate bond, Morgan Stanley was there to warehouse that bond and effectively keep the company from going bankrupt when it really shouldn't be going bankrupt, just because customers needed liquidity. So one function that we'll play is when everyone's getting margin called on GDAX or whatever, and you have a flash crash, what should happen kind of going forward, you know, I think that caught a lot of people off guard. The algos are just getting into space. That kind of, I don't want to say that it'll be less likely, but you know, frankly, this is a very hotly debated topic. There are academic papers that say when you add derivatives, when you add futures to a commodity market, it becomes less volatile. And there are other people who say it becomes more volatile. My view is the space as a whole will become less volatile as the capital markets become deeper, richer, as you have stronger hands and more professional kind of money management, because those are the people who buy the bid when everyone else is panicking.
I agree with you on the, you know, derivative component. You know, one issue I have is when you know, when you look to short an asset in this space, your upside is capped, right? If it goes to zero, you get 100% of what you invested. And when you're dealing with sort of exponentially growing assets, it's very hard to, sort of tune out the asymmetric risk reward, from the fundamental approach versus the capital markets approach. And, we saw this with banks, right? I mean, so banks were bailed out by the government because that being a buyer of last resort didn't even work for most of the banks. And they suffered from liquidity crises due to leverage. So, in order to kind of beat the market, you actually have to use leverage if you're going to take a market neutral approach, especially in like a growing asset class.
Look, your skepticism and the criticism are totally valid, totally. So we've had quant quakes in the traditional world where basically all of the quant funds are running very similar algorithms, and then they get caught off sides at the same time, and they all basically kind of puke their positions at the same time, and that exacerbates volatility. I'm not a champion of trading in general. So this will make me incredibly unpopular among any traders who are watching. But there was something floated during the financial crisis called a Tobin tax, and the idea of a Tobin tax was it was recommended by an economist. I think it was James Tobin. I may be getting the first name wrong. Who said we should put some small transaction tax on every financial transaction, every transaction that's speculative in nature. And you could even include it on things that are non-speculative. Like, let's say you want to buy Microsoft stock. If you're buy and hold and I add a 5 basis point tax to that, it has no effect on you. It doesn't impact your bottom line. But if you're a high frequency trader, if you're an active day trader, it kind of puts you out of business. So the argument was initially that this would raise money and it would be kind of punitive and hurt traders. And I actually supported it because we have this arms race in trading. Trading, because it was a way to get rich, it attracted a lot of the world's best physicists and electrical engineers and computer scientists over the span of 15 years to engage in this kind of algorithmic arms race that I think adds very little value. So once you have, Warren Buffett very famously instructed the market makers of Berkshire Hathaway to keep the bid-ask spread relatively wide. And you'd say, wouldn't a tighter bid-ask spread, and the bid-ask spread is just the difference between the bid and the offer that the market maker is showing, wouldn't a tighter bid-ask spread benefit the consumer, benefit the person who's investing? And Buffett basically said, if someone's investing the way I want them to, which is they're going to buy and hold it for 5 years or 10 years, it makes no difference if it's 1/8 of a dollar or 1/16 of a dollar. This was way back in the day before we'd gone to pennies, right? But the idea is that by having it wider, it would really discourage that kind of intraday speculation because it would make it clear to people that they were paying a real price to kind of be speculators. So I agree. Once you have a certain amount of liquidity in the market, adding more doesn't really make things more efficient. It doesn't help developers raise capital. With that said, we're at a point right now where it's a weird point. So the markets are horribly inefficient. For example, there was just the ICO, I think it was yesterday, where there was a man-in-the-middle attack where the Ethereum deposit address was changed, where people donated $7 million to a thief, basically.
Yeah, CoinDash yesterday morning.
Yeah, CoinDash. There are a lot of people who would be allocating capital who aren't for reasons like that, and there are a lot of people who shouldn't be allocating capital who are because they're not doing any research into the projects. At some point, you're going to have a freezing effect where the people who've been investing in bad projects and scams will lose their money. They'll temporarily stop. It'll be hard for developers to raise money. Having the mature capital market, I think, is beneficial. Another thing is that for the store of value usage, when we talk about Bitcoin as being valuable fundamentally, or whatever, when I say Bitcoin, I very much believe in the store of value use case. Bitcoin will fill it or something else. If Bitcoin died tomorrow, like people will sometimes ask me, and this is a straw man argument for you guys because I think we all agree this isn't going away. But people will say, well, what are the risks the entire thing goes away? And my answer is, there are industries that have gone away in the past where a country will have a banking crisis that wipes out every bank, and 2 years later you have banks because there's a fundamental demand for banking. Every airline company could go bankrupt. You're going to have airline companies because we want to fly. And similarly, if every cryptocurrency went under tomorrow, a year later there'd be a bunch of new ones because there's that fundamental demand. Alex, I feel like I've been kind of not unintentionally dodging your question about the kind of separation of use cases, and you've kind of woven it in with the provision of liquidity. So let me try to kind of tackle a little bit more head on. So for something like Bitcoin, the store of value, just having deep liquid capital markets, having hedging ability, futures, options, having the ability to transmit massive size. So, to us, 50 million of liquidity is a lot. to a sovereign wealth fund or a pension fund, it's nothing. So when you say that Bitcoin is $500 million of daily liquidity, that sounds like a lot to you and I. It's actually not that much to anyone who is to the big players who need to think of it as a store of value. So getting that up to a few $1 billion a day, for example, makes it a much more interesting asset for sovereign wealth funds, pensions, endowments, and even very high net worth individuals, a Bill Gates type, to put 1% of his wealth in. Having those liquid markets makes it easier to do things like what Ripple's trying to do, or even what BitPeso's trying to do. So if you have a very, very, like we just talked volatility. So everyone's trying to create a stable coin. So you have like MakerDAO, which is a really interesting project. And there are a few other projects that are trying to create a stable coin kind of in broad terms, something that is basically pegged to a basket or a currency. And there are all different ways to do it. So you have Tether, which does it by having kind of a company with counterparty risk. One way, and I think there will probably be a solution. I don't know if it's MakerDAO. Someone will probably come up with a solution. But just having tremendously more, Bitcoin is much less volatile today than it was when it was $1. It's much less volatile today as a $40 billion asset than it was as a $1 billion asset. So as these markets become more liquid, they'll start acting more like currencies, especially the store of value ones, and that will make them more valuable and useful, because a BitPesa won't even have to worry about locking in the price, because if the price is only moving a couple percent a day, they don't have to worry about that exchange rate risk over 30 minutes. Whereas right now they're worried, because in 30 minutes, Bitcoin could move to 15%.
That's true.
For the other use cases, I think you guys add more value in terms of properly valuing a decentralized file storage network, or an innovative exchange platform.
Ari, thank you for that view. So we're at the top of the hour, so we got to wrap up. But before we go, I'd love to hear just kind of your quick take. The big question everyone is talking about is like, are we in a bubble? Are we coming off of a bubble, more accurately? And what is your outlook, let's say, for the next 2, 3, 4, 5 years here?
Sure. So it's a weird situation for an investor where I'm very confident that there's a massive amount of money on the sidelines that's about to come in, and that's from a lot of angles. So Coinbase is adding 30 accounts a day. They have like a 2-week backlog of onboarding people. That's just one example. Tons of people they're gradually become familiar. Now Bitcoin's on the cover of the Wall Street Journal every 2 days. Ethereum's on the Wall Street Journal every 3rd day. People are becoming comfortable. The capital markets are becoming more liquid. You have things like structured notes that are issued by bulge bracket banks and insured by Lloyd's of London that are starting to be marketed to institutional investors. I think an institutional investor, like an endowment, will probably invest in the space in the next 6 months, and that will kind of be the first wave in. The market cap of crypto is less than McDonald's. McDonald's is 110 billion market cap. All of crypto today is, I haven't looked this morning, something like 75 billion, maybe 80. It's trivial in size from a global perspective. It's so massively undervalued. With that said, the model I think back to a lot is kind of the NASDAQ tech boom. The problem is a lot of the winning tech companies that are around today didn't exist in 1995. So you could have known the internet will be here, the internet will survive. You could have easily lost money. If you started investing in tech stocks in 1990 and just held, you could have lost money, because most of them went bankrupt. So a concern that I have is that when I look at individual cryptocurrencies, most shouldn't exist. And that's not a maximalist argument. That's just individual. This one is kind of a crappy protocol for decentralized file storage, or this one is just a mediocre protocol for what it's trying to do. It's very likely something will leapfrog it and provide a radically better protocol to do that. So I'm kind of torn. So like a lot of the things that have fallen 70% in the last week should have fallen 70%. I don't view those as sales. It's a repricing of something that is vaporware or is a good idea, but it's a year or 2 years away from fruition. It's being valued at $200 million, which is just absurd. If it wasn't, the only reason is because it had an ICO. If it was VCs valuing the thing, they'd valued it at $10 million as an interesting seed project. With that said, the space as a whole is massively undervalued. So how do I kind of bridge those two? One is some of the winning protocols that will be the biggest in the world in 4 years haven't been invented yet, or they're ICOing right now, or they're being invented right now. Some of them won't be invented for 2 years, And the other thing is I as an investor, from a total market cap perspective, I think a lot of value is going to accrue to a relatively small number of store value coins. So kind of the one sentence answer is, crypto as a whole is at the 3rd inning of a massive bull market that I'm confident will continue just from a money flows perspective. We're at 70 billion. There's 300 billion globally that wants to get in now, that needs an ETF or insured structured notes, that needs a vehicle, that needs custodial services to invest in funds like the one I'm offering. With that said, it doesn't mean that you can just kind of close your eyes and buy random coins that are down a lot, because a lot of those will go to zero because they're fundamentally not valuable.
Awesome. Cool. Well, thank you very much for that view. And again, thank you for coming on and taking the time to talk with us. Love to have you back at some point, check in maybe in a few months and see how this all shakes out. And if anyone wants to follow you, like, what's the best way to read your stuff? Is it Twitter? Is it Medium? Or
so I'm at Ari David Paul on Twitter. I occasionally post to a blog, the cryptocurrencyinvestor.com. Now that we're going forward with a firm, I'm meeting with the lawyers. Basically say don't talk to anyone ever. Lock yourself in a room. Fortunately, it's not that strict, but I'm not sure. I'd say follow me on Twitter, and then anything else I do, I'll link to it.
Okay, fantastic. Cool. Thank you very much, and take care.
Thank you.